journey to new frontiers, how family offices, endowment funds are structuring the new quiet renaissance. This panel is really where we take that metaphor of the Ark, this ship that is supposed to be the last on Earth, to reality. We put together family offices alongside endowment fund and other capital allocators to understand how the old world, how the old money can fund the new world. A new world that would be more resilient to climate change, a new world that would be better structured. And so we played in that boat an idea around the fact that we had 150 people, and could these people be really the last survivor on Earth? And if they were those last survivors, why would have then been picked to be rebuilding the civilization? And this panel is really representing that. So we had the chance to have some of the old world, the 𝗥𝗲𝗱, talking alongside some of the new tech world, the Cisco, alongside some of the new investing players, VCs and founders that are building resilient companies. So yeah, I think this is quite a good one and you should check it out. I hope you will enjoy this panel about resilience, climate, and how do we shape a better future for this new world that is actually taking shape right now. Enjoy. So I'm really glad to have you, Jocelyn, coming back for the second time in a row. High five. Onto the aircraft carrier, onto the Ark. Thank you so much. Jocelyn here has been leading Cisco Foundation, investing into funds across all around the world, really, and into companies. And you're going to tell us a little bit about the work that you could do at Cisco. And it's great to have a corporate foundation here on stage to represent that kind of old money, but not too old, right? Because we're in the tech Silicon Valley here, we have these giants, right? So thanks, Jocelyn. We have Shenando here, representing the really old money this time, 𝗥𝗲𝗱, right? So this is like the guys that have built this country railroads and all this infrastructure. And we're gonna see from your perspective, from the past to the future, where are you guys looking at? And thanks to your lens, we have not only America, but also the South and the global South in your perspective and how you guys see that. It's going to be very exciting. And then we have Darren. Darren have this incredible thesis, not on just making money to LPs, but also making sure that they do that, keeping in mind plus 2.5 degrees of adaptation. And guess what? Today on this ship, the scenario is that we actually had that happen. We broke the Atlantic IMOC, so this is the last ship on Earth. So in that scenario, we really need this guy as our guru to tell us, what to do next. So Darren here, adapt.us, is one of the first adaptation and resilience VC that I've heard of, and I'm really glad to have you guys on stage. I've been tracking you for a long time, so it's an honor to have you. Thank you so much.
Thank you, thank you.
And then we have my friend here, Scott, who is representing not only the old money from his own family office, but also millions of people, literally millions of people in their pensions, right? So pension funds, endowments, here we go. Pension funds, endowment funds, this is $1 trillion of capital sitting around right now. And too many times, this capital, your pension money, your retirement money is going to be wasted in hype cycles, in market volatility. How do we make sure that this doesn't happen that much so we can take some of these billions that we save, not being wasted, and reallocate them to climate capital? And that's Investatio, that's the company you're funding. So you're doing a big job here, Scott. Thank you for telling us about this insight today. And lastly, we have Jim Fournier. Jim is one of these the name, if you Google his name, it's a multi-generation family office. And Jim here is one of the guys that I honestly think are rare. We need more of Jims. Can you clone yourself, Jim? We need more people from the family office side who, for the past 20 years, and hopefully for the next 20 years, are thinking resilience and sustainability at their core from their DNA. And Jim is one of them. Jim have been not quitting across the different market cycle to try to do good with the capital of his family, and we need more people like him. So yeah, without further ado, I will introduce Cassandra, our moderator for this panel. And Cassandra, as you know, is really caring about existential resilience across both her own personal investments and her fund's investments and the family office that she has as well. This has been the conducting line for her existential resilience with 𝗙𝗲𝗱 Capital, and she's going to moderate this panel. Thank you.
Thanks. Hey everyone, thank you for being here. Thank you all for taking the time, flying in from all over the country, all over the world to be on this panel today. Joan already introduced this concept incredibly well, but again, it's this feeling of an inflection point and really the underlying risks that we're facing across all of these areas, these very existentially related areas. We feel that we need to examine how capital is actually behaving today at this inflection point. So without further ado, let's just jump right in. Actually, I'd like each panelist, maybe we'll start with you, Jocelyn. Let's just take 30 seconds to a minute each. Tell me your feelings about this. I think many of the most important problems across energy, infrastructure, climate resilience are also the hardest to fund through traditional venture models. This is also a conversation, forgive me for running up here late, it's a conversation I was literally just having in the back of the room. What role do non-traditional sources of capital, so what all of you on the panel represent, foundations, corporates, family offices, need to play in actually bridging that gap? Please just pop down the line in 30 seconds to 1 minute each.
I love this question. It's a personal thing I geek out on a lot, and part of why I took the role when Cisco Foundation created the climate commitment, took that so excitingly. When we created our pool of capital we refer to as the Regenerative Future Fund, it is really anything beyond grants. We titled it as impact investing, but we really wanted to make sure it moved the needle and what the climate space needed. And while we do some traditional kind of VC early stage climate tech, while we participate as LPs in funds, we also have a part of our thesis that is about accelerating and advancing the appropriate capital necessary for climate innovations. And we don't paint that with a cross-cutting brush saying, climate tech as a whole. Actually zooming into the different verticals and thinking about the exit pathways, thinking about the business structures, thinking about the products available, and trying to act as a connector in the space where we sit between the venture world and the philanthropy world in trying to co-create and build these. My personal background is in innovative finance, building innovative financial products worldwide that were addressing specifically social and environmental impact objectives. And so I know it can be done. Something I always talk about, and I truly philosophically believe, is that finance is just a blank contract. You can make it say whatever you want to say is exchanging values of two players at the table or more. And so I think we need to go back to those principles and saying we now have come to a consensus as a community that a lot of these capital pathways or VC pathways might not be appropriate, and so what? Let's start with a blank piece of paper and let's come up with or adapt some of the existing structures for comfort reasons or for acceleration and speed reasons, and let's bring some new ideas to market. And there are some individuals, and both on a high net worth individual, family office, and foundation level that I've met in the last 18 months specifically that are all on the same page. And so I think we actually are at this really critical time where specifically as a kind of venture philanthropy positioned fund, we can play a role as connecting, getting some initial capital in, and building a lot of bridges necessary for that. But that might have been over a minute, but I love that question.
So from the Rockefeller Foundation side, I oversee a portfolio of grants, but that being said, we're always aiming to be catalytic in everything that we do, right? We view the grants that we're making in the power and energy space as really trying to unlock as many downstream investments and involvement as much as possible, right? That's at the core of how we operate in the grant making space. So my focus really is making sure that we can deliver energy cleanly, affordably, and abundantly to all of the countries in which we do work. And our focus really is across the global south, right? So Africa, Southeast Asia, and India, parts of Latin America as well. And so what we're really making sure to do here is deliver on this promise of universal energy abundance. That's at the core of what we do, and making sure that populations in these places are able to increase their per capita consumption from, barely 1,000 kilowatt hours per capita, which is barely enough to power, lights in one's homes for a year, to at least, 3,000 to 4,000 kilowatt hours per capita per year. That's at the core of what we do, and that's our mission.
So I guess I'm the different one here who I don't have a foundation behind me. Ugh.
Boring.
Boring. I'm actually just the fun that's out there trying to allocate capital and trying to do so in a space where it's something like 0.25% of all capital is going into adaptation. And that has to cover the massive seawalls that need to be built and all the municipal debt around adaptation, let alone innovation into the space where I play at as an early stage VC investor in adaptation. So how much money do I get? When I go in iPhone family offices, I say I'm in climate can you let me finish? It's adaptation, it's not just climate. Like it's a space that's really, really missed. But I have a question for the people here in the audience. Have you changed your buying behaviors in any way because it's hotter and more volatile? I've changed what I'm buying. That's the secret, and that's the difference, I think, that at least the approach that we think we have to take is about finding the demand, where are markets going, and what are people doing with their money. That is where we need to go and invest, and that's where I should be in the capital stack. The companies where the first demand is there, I can go and help accelerate that and make sure that the companies can actually scale, and it's about scaling the business. Then I need other people in the capital stack to be able to go, the companies that we don't quite know if demand is there, we don't quite know if the market will succeed, that's where I need other people to be helping along in the capital stack to make sure that that is successful. And so that way we can all come in to make sure that this actually works for it to be successful. The last thing I would add is, I think part of the mindset shift we have to have is we have to stop thinking that a founder has to fit my model as a VC. We have to start thinking that my customer is not my LP for me to get a management fee. My customer is the founder and what they're building and what do they need to build successfully, and that's actually how I will become successful. So demand first, think about the customer who is the startup, and then think about where I am good with my capital and other people are needed in their capital.
So I'm going to answer the question with a story, and this story might be something that everybody here could relate to. So since I've been 10, I've been waking up most days trying to optimize two things: be good for the environment and be good for economics. I'm 51 now. Until I was 48, I woke up and those two things were distinct from each other. I was doing what was good for the environment in my personal choices and like charitable boards that I'm on, and I worked in Wall Street. I then learned the impact of my money relative to the climate. And I was flabbergasted, or for whatever other bad word or they can think of, and I didn't realize that my money, while I want my money to work for me while I'm working, I didn't really realize that the money that I don't think about, my personal banking, my retirement plan, was working against the climate at a 20 to 30% clip every day. And when I realized that, I instantaneously changed my household's money to be at a green bank where I was actually getting equal interest rate, like 3 percentage points. I get good service, so good economics already. And 100% of my deposits are now being lent out to climate solutions instead of funding oil and gas, dirty manufacturing. And the same can be applied on your investments. Everyone here has two really key resources, time and money. Use a little bit of your time. It took me 1 hour to change my bank. I'm now having impact every day while I sleep for the 1 hour it took me to change my bank. On your investment side, depending on your acumen, your money can be as impactful too. And it's the money to focus on is actually not what you're invested in the stock market. Not at all. In the stock market, if you want to have climate impact, vote your shares. It has zero impact if you reallocate your equity. But for the little bit of money you might have in fixed income, or for this, private investments, if you have enough personal money, or through your business endeavors you have personal money to invest in venture capital, be very explicit on what your fixed income and debt is invested in, and be very selective on investing in startups. That's how your money can work for you while you're working in a way that you may not have realized before. And I bet a lot of you wake up every day being like, how do I make money? And how can I save the environment? Now maybe you can do more tomorrow than you did yesterday.
So mostly on the for-profit side, we're focused on energy transformation. And to a large degree, the part of climate that's linked to energy seems to be rapidly solving itself for economic reasons. Never mind what's happening with the current regime. It's, you know, and the investment doubled, I think, this last year or something in spite of it. The area that I've become much more concerned about that isn't being driven by that, both for climate and by itself, is biodiversity and nature. Because this is the really irrecoverable situation on the planet. It's linked to climate. Climate drives it, and to fix climate, we need to fix it. But at this point, the only way we're really able to touch that is through philanthropy. Although what we are doing is taking philanthropy dollars through a DAF and investing in early stage or self-sustaining approaches to that space. We're actually in a fund called Superorganism that's having its LP meeting at my property tomorrow. So if anybody's interested in becoming an LP in that fund, come see me. And it's frightening. You know, we're not doing nearly enough.
Thank you, Jim. Actually, sorry, can I leave the mic with Jim, since I already have him there? And you said that you're investing in energy transformation. I also read a piece. If you go to Jim's LinkedIn profile, he wrote a piece, I think several decades ago now, that is still incredibly relevant and salient to today. Anyway, you know, because I had nothing to do last night at 2 a.m., I read through that entire piece. And in that piece, Jim, you've described global systems as approaching an inflection point. I won't go into all the detail that the piece does, but from your perspective, what does that actually look like today as in the context of real-world systems like energy and infrastructure?
Okay, well, thank you for raising this. It's a big philosophical piece, but if you think about what's happening in the world, it feels like we're in this asymptotic growth, like it's just taking off to infinity. And you get the people talking about the singularity, and it seems to sort of resemble born-again Christian philosophy that, you know, we escape. From a scientific point of view, you know, if you have systems doing that, they tend to have something called a J-curve, where they crash. So the problem is, you know, where are we that we're not going to be a J-curve and we're not going to take off to magical thinking? And if you look at the adoption of technologies, all technologies go through an S-curve, where they start out slowly, they ramp very fast, and then head towards some sort of plateau. And we're in the midst of seeing this with renewables and solar right now. I mean, in fact, what's not being seen is how fast the vertical part of that curve is going to kill fossil. But if you stand way back and you look at the whole of civilization and the whole of history and all of the things that are simultaneously undergoing S-curves right now, you could step back and say, well, maybe all of civilization is undergoing some sort of S-curve. And if the plateau state that came from was nature, what does the plateau that we're headed towards look like? And I call it meta-nature. And the idea is that as you get mastery over matter, you figure out how to put silicon and carbon and all of the elements together in elegant ways that approach the kind of elegance that nature has, but that only humans and human technology can bring into being. There is a kind of completeness. Once you complete certain moves in matter, you don't do them again. And then it becomes a question of how, once you have something efficient enough, how long would you want to keep it? Because the payback starts being longevity. If you can build a solar panel that lasts for 7 generations, you're kind of done. So that is a very brief synopsis of this thesis.
Thank you, Jim. It's very intriguing. To kind of zoom in a little bit, I'll pop over to you, 𝗠ando, because earlier you were describing how at Rockefeller you're focused on catalytic capital. My understanding is that when a novel or really system-level opportunity arises, grant and concessionary capital tend to show up where commercial capital won't. What does philanthropic capital's role as a gap filler reveal regarding blind spots in the energy investment space, or broadly this investment space?
Yeah, I think this is an excellent discussion point. So I think one of the biggest places where we come in as a grant maker is around ecosystem building and systems enablement, right? And so these are things where we've, we have initiatives like Mission 300, which aims to bring 300 million people in Africa electricity by 2030. We also have other big bets through our biggest grantee, which is the Global Energy Alliance, right? And so the kind of work that they are doing around developing regulations, making sure that the right sort of workforce development is taking place, things like even power grids, right? And a lot of these sorts of underlying infrastructure plays. These are extremely unsexy things, right? But they're crucial and they're critical and they're very important. They won't show up on a deal pipeline, but without these kinds of activities, you don't have a deal pipeline, right? And so those are exactly the sorts of things that we try to do at the Rockefeller Center, at the Rockefeller Foundation, through all of these items that I mentioned.
Thank you. Jocelyn, I'd be curious to hear your perspective on the corporate foundation side when you're deploying early stage capital with quite a different mandate from also, as with 𝗠ando, very different mandate than traditional VC. Where does that perhaps allow you to take more or different risk, or perhaps even move earlier than the rest of the market?
Yeah, I think the place I'm most proud it allows us to play a bit more is, going back to maybe your initial question, is we can be more patient. And sectors that are really going to move the needle in climate action are needing that patience. That includes hardware, nature-based solutions, for example. And to me, that's what's necessary. Maybe tying everything together, the feedback for us, we don't serve multiple LPs. So we've always seen our customer and our job is being there for the founders. And when the journey is really long, or the capital stack's really complicated, or the amount of cross-sector collaboration in order to untap a certain market is crucial, or even certain policy plays we're making key bets on are going to play out in a certain time frame, or certain customers that might be government agencies or related or tangential to or parallel to government agencies. But we see the solution as necessary and critical and have a high potential to scale once we kind of lock in some of those initial customers. We want to be those partners along that journey, and we want to be able to leverage the brand in which we are associated with to be able to provide the momentum necessary that can help these companies succeed. So there's a lot of roles we see in it on kind of supporting early stage ventures, and then also on, as mentioned earlier, and also just being able to pause and help stakeholders rethink capital pathways and capital opportunities. And in the world of AI, I might add to it as well, allowing us to take a pause and thinking about the data that is necessary for some of these AI solutions to scale, and being able to utilize philanthropic capital to really invest in the quality and reliability of the data sets that are foundational for certain innovation across sectors to really take off. And we talk about climate a lot of time as one word, but even talking about biodiversity, there's some amazing data sets that are available in research institutions and in universities, and it's more about, okay, now how do we amplify those and prepare those to be built into commercial solutions? And there's a lot of work that happens in the connection and the acceleration of all of that, and that's where philanthropic capital is also plays a really important role if we even want to just zoom in on some of the trends today, like AI.
Thank you very much. I think this perspective is something that unites all of the panelists on this stage, because they're true patient capital, long-term thinkers. And Darren, I'll go to you, because although you are investing not from a foundation or a corporate, your venture firm is incredibly focused on the same issues, the same mentality around patient capital in a way. When you specifically propose your thesis of a 2.5 degree hotter world, are LPs actually underwriting that reality, or do you feel that they're still grounded in this narrative of climate mitigation rather than adaptation and regeneration?
So I think we have to follow some of the data here. So my understanding is there's about 300 trillion of investable capital in the world. About 3 trillion of that cares about impact. 85% of that 3 trillion says, give me market rates of return while I care about impact. So there's a question of how much impact they really care about, or at least they're not seeming to be willing to make a trade-off, which intellectually I just think is dishonest. So I end up having to be, I'm this pragmatic middle, right? Like if you look at my pitch deck, I'm raising capital right now. It's 29 pages of how I'm going to make you money. It is predictable alpha. Like there's nothing more predictable right now than the shift in demand we are going to see from the weather getting hotter and more volatile. It is a favorable beta. Investing in me hedges other existing investments you make. And the 30th page says, oh, one more thing. I only invest in companies that improve the quality of life for humanity. No ice cream, no sugary drinks. I get that demand's going to go up for that. It's coastal erosion. The first investment we made was air conditioning. It is a new form of bringing passive radiative cooling into the home that'll be 20 times more efficient at delivering air conditioning, so that way we can make air conditioning cheaper for everyone. Yes, that means us in North America and the global south, and that's how we're going to have impact. But that is page 30. Right? Because unfortunately, when I'm out raising money, the questions that get asked for the 29 pages, the brutal, honest truth is people are saying, show me the money first. And if you can come with the other things, that's great. And remember that we're a biased group in this room. If there's anyone who would sit here and I should switch my pitch for, it's people in this room. But unfortunately, LPs, I don't think, are actually, on average, really worrying so much about the impact as they do for show me the financial returns. They don't want to necessarily underwrite some of this risk and things like that I'm asking them to take on. I'm too much in the pragmatic middle for people. I focus on demand, right? Where's the money going? And I'm using that. Because the last thing I would add, part of this, it comes from our own perspective of impact. If you've ever done any of the study, or looked at any of the history or studies behind happiness, if you want to be happy, you go to Las Vegas, you party a lot, you do some drugs, and then you end up, miserable, right? No, you actually have to go live a life of meaning with some purpose in it. You roll up your sleeves, you work hard, you feel fulfilled, you feel happy at the end. Our view of impact is the same thing. The best thing I can do is to go and help the climate and to go and help with humanity is go and build profitable businesses that actually scale, that people will spend their money on, that happen to also improve the quality of life for humanity, like the air conditioning company does. That's the best thing I can do. I get to the impact indirectly. And so it is something that I think I'm seeing LPs focus more on the money. But I will always stick to my thesis, which is making adaptation cheaper for everyone, and that will have the impact. And I'll sleep at night, and I'll make them some money along the way as well.
There you go. I mean, that underlying truth that great financial returns and great impact do not have to be and are not mutually exclusive. And I appreciate that you're fighting for that. Speaking of just capital flows and how capital is moving, Scott, you've spent a lot of time looking at how capital moves across institutions, across portfolios. Earlier in your intro, you brought up this really interesting kind of revelation that you had of your retirement money, for example, going against climate. Where do you feel are the biggest untapped pools of capital today that could be redirected into climate and resilience?
Yeah, so I think there's two pools of money that are basically zombie money that can be catalyzed, right? One is global pensions and retirement plans, and the second is corporate treasuries. Now think about some of the people on this panel are some of the smartest money in the world, right? Whether it's venture capitalists or private equity or really smart family offices. Those asset pools that have a long-term time horizon and the smartest money in the world, about 12% of their current investments globally, so VC, private equity, climate-forward family offices, are invested in climate solutions. Now think about retirement plans. They also have a long-term time horizon, right? Retirement plans are meant to do two things. Help you have finances in your retirement and help you live a dignified retirement. If the climate continues to get destroyed, you won't be having a dignified retirement, right? And so at a magnitude scale, retirement assets in the world are $100 trillion or more dollars. The climate funding needed for the world is $6 trillion. Right now, that $100 trillion is thinly invested in climate solutions, maybe 1% versus the 12% of private equity and venture capital. If more stakeholders in retirement plans state their interest, right, and actually reallocating at a long-term time horizon in a similar way that the smartest money in the world is, more people will have a financially and dignified retirement. Second is corporate treasuries. Corporate treasury, people don't understand that much, right? It tends to be short-term fixed income and cash, right? Short-term fixed income tends to invest in government bonds wherever in the world you are. Government bonds, depending on the government, but for most governments, are not a climate solution, right? But if you just reallocated some of that money in corporate treasury to a different kind of bond instrument that had liquidity, like a green bond or a blue bond or some other bond fund, that corporate treasury could actually be being, one, intentional about its money, two, align to the values of the corporation that they're part of, and three, actually be a climate solution while still earning the same amount of interest while it's sitting in treasury.
Thank you. We unfortunately are going to get cut off of time pretty quickly here. I think we have about 8 minutes left. So I want to just shift, and I want your brilliant brains to have much more time to shine, but I want to shift from this idea around what type of capital, the approach to investing, where it needs to go towards that level of resilience and achieving true adaptation, regeneration, et cetera, to what actually needs to be funded in order to make that happen. So maybe think in bullet points, stick to a minute so that everyone has a chance to throw some ideas out here. But when we think about capital shaping what actually gets built, let me start here with Jocelyn. Where are you seeing truly regenerative approaches emerge that actually rebuild or restore systems rather than just optimize them?
That's a great question. And I guess what I'd also just add to is just rethinking. We are also LPs in superorganism, and I do think biodiversity and just realizing that investing in biodiversity is investing in the resources that fuel our entire economy is critical, and really important to kind of restate in our capital markets the value of our natural resources. The other area that I'm really excited and recently, and also represented on this panel, that is coming to the forefront of climate investing is investing in climate adaptation, and no longer having that in the periphery, and really linking and understanding the value and the tie to like how much capital is lost from a corporate, from an economic, and even a household level if we don't start investing in this now. And so I do truly, those are maybe my two answers to that question.
Thank you. Then thank you for your promptness. Scott, tossing it over to you, please. When you look across portfolios, where do you see the most compelling opportunities combining real-world impact with strong financial returns? So dive into basically the concept that Darren teed you up for there.
Yeah, and I'm going to extend on the regenerative angle and adaptation resilience because, one, we all know that time is scarce, right? We need to act soon, and so you need to invest in the things that are intuitive for a lot of investors, but also have good financial returns. I think the sweet spot is things that are a combination of, I call it food systems and nature-based, and adaptation resilience, right? So think of watershed bonds. Right, mangroves, coral reef restoration, that gives you mitigation, it gives you adaptation and resilience, it gives you biodiversity all at the same time. And it's intuitive, like it just feels good to invest in that, right? And you'll have a financial return, you'll do the due diligence, listen to experts, but that action is intuitive, it feels good, and it can be done for the masses or it can be done for institutional capital. Same thing for food systems, regenerative agriculture. One, you're getting healthier food. You're getting soil sequestration. You're getting better livestock management. And by making the soil more regenerative, you're also got adaptation resilience for dry climates and other things, right? So things that are like double silver bullets, triple silver bullets are intuitive and with expertise, but also don't let perfection get in the way of good. Act quickly on investing those things with a little bit of investment scrutiny, and that's a way to catalyze a lot of change and also protect us.
Excellent, thank you. Darren, may I toss it back to you briefly? So you're explicitly investing in a hotter world. What becomes inevitable in that scenario, and what is still underfunded because the market is reluctant to face that reality?
So one, when the premise is here, I do think it's the role of government to force us to price externalities, which means we should have things like biodiversity credits, carbon credits, and things like that. Until we have them and the government does their role, unfortunately, we need some philanthropies to step in and to help out to make these things more investable. And then you come down to your question about like what becomes inevitable. I think that like the single biggest problem we have is heat. That is going to be the single biggest problem, and dealing with heat, right? Why do we go and look there for a lot of investments, our first investment in that space? I think the one that's I find surprising, if you go, GIC published a report in conjunction with Bain. They did a bunch of growth curves and what that would look like under different scenarios. The one that shocked me was wind. Wind is actually something that there is still going to be a dramatic impact going forward with, and there's a great opportunity there. We always think about floods, we think about wildfire, we think about some food and like supply chain, we think about heat. Wind seems to be the one to me that is the one that's a little bit more surprising. The one last thing I'd point out, I love this stuff that we're talking about with some of the biodiversity and things like that. We've also invested in a company that actually creates electricity from soil, right? These are back to your 𝗙𝗍𝗱s, right? It's a different form of renewable energy that we've never seen before. And because the reactor is buried in the ground, it can survive a flood, it can survive a hurricane go over top of it, and will still deliver consistent power. These are the types of things that we love that fit everything.
That's excellent. Thank you very much. And I encourage you all to follow up with these folks after the panel to get even more ideas. Jim, a lot of capital is racing to meet projected AI-driven power demand. I know that this is a space that you are actively investing in and around energy infrastructure generally, but flowing capital into power, into generation, is that the real bottleneck, and are we solving the right problems there?
Well, I think we need grid modernization, and there hasn't been growth in the grid, so there hasn't been capital in it for a long time. So in many ways, data centers are doing positive things for the grid. They're driving a lot of grid modernization. Also, counterintuitively, if you add demand, you can actually drive down rates because the grid is underutilized right now. So it's very counterintuitive. Right now, also, there's a lot of people chasing, putting jet engines behind the meter for plants. Those are going to fail in a year because they burn them out cycling them. The cheapest, fastest place to get more power on the grid is through software running VPPs, like turning down people's appliances and so on with software to get that capacity out of it. But also on the data center side, through a fund that we're in that is very AI focused, Untapped Ventures, George Banadarian's fund, we got access to a company that has a chip that was designed to be thermodynamically efficient. So it can be 10,000 times more energy efficient running AI. And if we end up having a scenario where the grid gets modernized because everybody projects the AI demand taking off to infinity, and then it turns out that we can do much better on the AI demand, we might end up with the grid that we need for the electrification of everything, including making SAF and all these things that we want to do with it. So I try and look for these kind of pro-noia scenarios, and then this will probably be the best investment we've ever made, both on climate and profit. It's called exothermic.
That's fascinating. Thank you, Jim. I know we're officially out of time. I'm going to beg for 30 seconds more, maybe a minute. I'd like Shenando to follow up on that point because I saw you nodding your head quite a lot from your vantage point in energy transition. Well, how do you feel about what Jim just said, but also where do you see the biggest gaps between what needs to be built and what's actually getting funding?
Yeah. So I'm going to keep this quick, but as the person with the privilege of having the last word, just a shout out to my fellow panelists for bringing up some excellent points. Jocelyn, love what you said earlier about patient capital and having longer time horizons, right? And building off of that, right? And Jim, going to your point as well, this is my second time on this panel, and I can't shut up about grids because grids are super, super important. And Jim, what you said about grids being underutilized is precisely the problem. When we talk about grid modernization, I'm not talking about actually building out more physical infrastructure. We don't really need that. We just need to optimize what's already there, and we can do that by embracing better software and AI. There's actually, I like to think of it as like a duality of AI for grids, but also grids for AI. It actually goes both ways, and that's really the key point here. And in terms of answering your question, Cassandra, look, I'll just end with this, right? I think the money that is missing right now is missing most from the global south and from emerging and developing markets. EMDE countries are going to make up 80% of demand growth through 2050, right? Yet they only get about 7% of clean energy investment. That has to be corrected, right? And that's really where I hope we can catalyze everybody in this room to try and address that.
Thank you very much, and thank you to all of the brilliant panelists. Give them a huge round of applause. I would encourage you to come up to each of them afterwards and dive into some of these topics even more deeply. I wish we had more time. Thank you for being here today.